Hey, what's going on, best ever listeners? I'm John Casman, and this is Multifamily Mastery. Listen, super excited today. We've got a great guest. We are talking to Jack Mullen. Jack, how are you today?
Hey, John, great. Doing well. Hey, day after Labor Day, trying to get everything going on a Monday. And actually a Monday, but it's a Tuesday. Doing okay,
Yeah,
though.
man, understood, man. I got my little ones running around. They got another day off from school. I'm like, I don't know how this schedule keeps working this way in your favor, man. But either way, they're hanging out, man, in the other rooms. Hopefully they don't disrupt us. But nonetheless, man, excited to chat with you and learn a little bit more about what you do as Summer Street Advisors. Why don't you give our listeners a little bit of your background?
Yeah, sure. I run a real estate due diligence advisory company. We also do investing as well. I formed that about 15 years ago during the great financial crisis. I'm a banker, came out, I was credit trained as a banker at JPM, Chase Manhattan Bank at the time, and then worked for GE Capital for a bunch of years. And then I formed Summer Street back in 2009. We were essentially a company that was working with a bunch of different institutional investors, non-institutional investors, looking at distress and doing a lot of things like that. We run like I said, really run a real estate advisory consulting company that focuses on real estate investing and from both a debt and equity perspective. We've been doing it for a bunch of years. We have 4 lines of business. We have outsourced underwriting, and we have appraisal management. We also do asset management, and we also do site inspections for one of the rating agencies. So we cover a bunch of ground. We also do another part of my business. We do some principal investing as well. So we've been around the block a little bit, John. So we a lot to cover, so to speak.
I love it, Jack. And listen, some of those terms may be a little different for our listeners, right? So you talked about due diligence advisory. You also do some principal investing as well and helping out with different investors. What exactly is due diligence advisory? Because that's, it's kind of feels like this in-between land of, broker, consultation, being the investor. Explain exactly what that is.
We have a number of different clients we work for. And again, a lot of the people we work for, we're a boutique shop, and we believe in long-term partnerships with our clients, and it really, our business breaks around probably about 70% debt related, the other 30% equity. And specifically, like one of the first large engagements we worked on was a company called Lone Star. They were buying a $3.5 billion bank. In Lone Star, they liked the idea of buying the bank. They looked at it as an opportunistic opportunity. They didn't have the resources to evaluate the bank, evaluate, the loans, what are the loans worth, what is the underlying collateral. And I have that ability to not only look at it from a debt perspective, performing debt, making new loans, evaluating existing opportunities, or as an LP investor, you want to look at, as an LP, investing in a particular multifamily project. Not all created equal, looking at a lot of different markets, a lot of different places, but to really understand kind of the opportunity and the pitfalls of doing that stuff. So that's kind of what we do. And we do it from very large institutional clients to family office and LP type folks.
No, I love it. I love it. So I get the large institutional investors. You mentioned family offices and LPs. What does that look like? Do they call you and say, hey, I'm thinking about investing in this deal. Would you take a look at it for me? Or what does that look like?
Yeah, I'll tell you, John, especially given this current environment, last couple of years, last 20 years or so, a lot of people made money in real estate. The reality is you can really buy anything and make money. Cap rate compression. You want an environment where cap rates are coming down. Anyone can buy it. Now is an environment where you really have to be tactical and thoughtful. You really have to have expertise. But we've had a number of instances where family office clients have come to us, things have been upside down, or LP investors, they're in projects and the GP, the owner, if you will, comes to someone and says, hey, we need you. You put in $150,000, a couple hundred, whatever the number is. And the owner is asking me to put more money in, because, initially this was a kind of a 3-year hold when I came in to invest that money. Now I'm being asked to put additional monies in, and then you're sitting here, I've already got $150,000 into this. They're asking me for another 150. Is this something that I want to do? And in a number of cases, candidly, we've had those discussions with people, and they're, looking at stuff in 80s vintage multifamily in Arizona. It was a value add play, 100 units and whatever it may be. And that we go into this thing and initially they're targeting a 20% IRR, whatever it may be. The value of the property is down 20-30%. The debt is a bridge loan that's matured. and then they're asking for additional monies to resize the deal, give them additional monies to finish the renovations. And in a lot of cases, you've already lost the initial investment, and now they're asking you to put additional monies in it. And I think you got to look at it as a new investment. And in a lot of cases, it doesn't make sense. You better to walk away and kind of. But we've been doing a fair amount of that for our LP family office investors, and also we're doing a fair amount of that work as well on the institutional side, as well. I'm sure we'll talk about. We've been most recently working with one of our clients is a CRE, CLO lender, one of these bridge lenders. We've been doing a fair amount of work with them, helping them collapse that securitization structure and doing a bunch of asset management workout stuff. But we can talk more about that, John, as we get into it, so to speak.
Yeah, Jack. I mean, just to explain really a capital call situation, right, where that LP investor got money in a deal, deal's not going according to plan due to a number of reasons, and there's a capital call where that operator says, "Hey, we need you to put another $100,000 in," and those investors then have to decide whether or not they're going to meet the capital call, and that's when they reach out to someone like yourself and say, "Hey, here's the situation. Can you take a look at this and let me know your thoughts?" And what you're saying is, a lot of times it actually doesn't make sense. And it's hard for people to essentially walk away or to get comfortable with a big investment and not trying to put more money behind it. But that's that sunken cost fallacy, right? Where they feel like, okay, well, I just need to keep investing more into this because maybe this will turn around. For those folks who are in those kind of deals, what kind of questions are you asking to make that decision of whether or not it's worth reinvesting into, more money to hopefully get through those issues?
John, this is a great question. These are great questions. And these are the questions we ask when we think about, right? And initially, when you evaluate the opportunity, how did it come to you, right? A lot of times these are value add. Again, everyone always believes, everyone loves multifamily housing. The theme across in this country is that there's not enough housing. We need more of it and the like. And I fundamentally believe in that. Not all created equal. Not all markets are created equal. Not all operators are created equal. So you got a number of instances, especially the last few years, probably starting in 21, 22, or 21 or so, 2021 and before, you got a bunch of operators that were opportunistically buy stuff. They were very good at raising money. They could raise money. The problem is they weren't necessarily, they were doing a value add play. What value add means is you buy a 1980s vintage multifamily, maybe 200 units in Arizona, and the premise was maybe you're looking at $1,000 rents, for a one bedroom or whatever it may be, and the idea was if I spend $5,000 to $10,000 per unit renovating it, that I could move the rents $150, $200, right? Because someone would pay up for that because it's they put in the stainless steel, they take away the brown cabinets and put in the white, they do the bathrooms, and they maybe do put in a playground, a little dog park, do those types of things, right? That's when they execute the plan, right? That's it. They go into the premise of, hey, this is what we're going to do. The challenge we've had is that a lot of the groups, a lot of these aggregator guys don't necessarily have the tactical expertise in a particular market, meaning they can't find the contractors. They spend, they spend not 5 or 10,000, they spend 20. Thirdly, that they spend the money and they don't get the rent lift. It's not a proven concept. So these are just the challenges on the upside, right? These are the operational challenges. And there's question one, when you're evaluating initially an opportunity, and then in the fact, if you want to put additional monies here, one, then two, you look at the financing aspect of it. Okay, we came into this, we bought it at, I don't know, say, at 100, say 150 a door. And now the property's worth 120, 110, right? It's a capital markets issue, right? The property's down 20, 30%, right? 2, 3, they initially did a bridge loan with one of our clients, one of our debt fund clients. And they said, hey, they went in, they believed the dream and everything else, we're going to create value. And now that bridge loan, that 2 or 3 year bridge loan, is coming due. And the property is now, it was worth 150, now it's worth 110. It's worth the debt. So what's going to happen here? The lender says to Mr. General Partner owners, guys, we're at 100% LTV, meaning we have as much debt in this project as it's owned. what are we going to do here? And in certain cases, it needs new capital. So the initial thing that the GP says or the owner says to people, his investors, he said, hey, investors, I want you guys to raise, give me some additional money. But you being an investor, you got to remember, you have a lot of different opportunities. You're an LP, you're a doctor, you're a lawyer, you're a professional investor, whatever it is, a family office person. You've got a diversified portfolio. You're looking over here and saying, this particular owner has not performed for me. Has not performed for me. And that's where you say, look at the new plan. What's the new plan? If there's new monies, what are we going to do? And that's where you make the choice of saying, hey, this may be the ship has sailed in this one. I don't necessarily believe they haven't executed the plan. Markets moved against them for whatever reason. They didn't have the tactical. They didn't have the people in place to do the renovation potentially. The cost went out of control. They didn't hedge the cost. They didn't get the rent lift. They didn't have the proven concept about, hey, spend 10 grand, you get 150 pop, 200 pop in rent. These guys have not executed for me on the execution side. Then you got the capital markets part of it, and so that's a very specific example that works for as an LP investor coming in or investor, looking at this as a vehicle to, do I stay on this horse? Do I like it? And then we also work on the debt side, on the restructuring side for debt players, in terms of evaluating the ownership or the LPs, or how are we going to fix this? And sometimes, but John, you and I talked a little bit with us before the call, you got to figure out where to fish, right? So sometimes when situations are upside down, what do you do? But that also represents an opportunity for others, right? Someone else's misfortune is someone else's opportunity to some degree, right? So my point is that distressed asset, that the owners, the existing owners may be out, so to speak. They know no other options, and the bank or the private credit group may take it back. But what they're looking for in a lot of cases is partners. They're looking for partners because they don't want to own it. One thing about bankers, they're very good at making loans, not good at operating properties. So it creates a lot of opportunities potentially for a group or an individual come in with new capital, but they got to know what the heck they're doing. And I think that's, John, I think one of the big lessons learned right now, at least in this period, it's all about execution. Yeah. You got to really, it's not a capital markets play. Where over the last 20 years, it's been very much a capital markets, cap rate compression, all that. Again, I'm a GE capital guy. I used to pat ourselves on the back, how much money we're making, right? Well, guess what? You buy something at 8, goes to a 6, you do nothing else than it just be in the right place at the right time. So I believe very much now is you can buy things opportunistically. You're from Ohio. I love Cincinnati. I know you're from Cincinnati. And I like that market. Not all properties, not all submarkets, and not all streets are created equal. But, it's a good market. And I believe that, appropriately priced. And I think a lot of this stuff, it's on the buy. You got to buy it right. You got to have a real concrete plan. And even when you put the plan together, you got to know that the plan is going to change. It always does. But those are some of the things. I probably went a little long here. I'm very passionate about what we do. We do a great job of it. And me, I'm super objective. However we got here, but we got to figure out why we're here and look at our options to kind of either to fix the particular problem, either it be a debt problem or a capital problem.
Yeah, Jack, the thing is that for most investors, when you get into that situation, it's tough, right? Emotionally, because the numbers could tell you one thing, but it's hard to reconcile, just come to grips that, hey, you know what, this investment might just be a sunk cost, right? And what we're getting at here is understanding when you have this situation, there's two components, right? There's the operational side of it, which is were we able to do the things that we thought we were going to do? Maybe it took longer to renovate units. Maybe we had to spend way more money than we thought. Maybe we ran out of money because we had to cover the higher interest rates. We had to replace reserves or something else, right? So the operational side, were we able to deliver on the business plan, or did we run into some issues? And then there's the financing side of it, right? Or the capital market side of it, where interest rates, where's the LTV, how much more capital do we need, what other loan requirements do we need? You've got to pair those two things together, and that's going to give you the picture of maybe the best way to move forward. So when you're talking about kind of these capital cost situations, it's not just, okay, let me write this check and, cross my fingers and hope it all works out. It's really reevaluating it almost as if it were a new deal, because you have to figure
100%.
out, hey, what's the likelihood that writing the check actually solves the issue? Because a lot of times it may not. If your plan was flawed from the beginning, whether or not you could have controlled it is not relevant at this point. But if it was flawed, that flaw still remains. So how are you going to address that flaw as opposed to just hoping the market improves? And I think that's the point you were getting at there. How do you talk to clients on the emotional side, especially when they've written big checks on these deals, and it's hard to come to grips that 6 figures, maybe even 7 figures, have just went down the drain?
John, it's not an easy discussion, but I kind of like sometimes, hey, wherever we are in life, sometimes we find ourselves. I once had somebody said, hey, you find yourself in a hole, stop digging. Right. My perspective on it is, if I'm dealing with a family office and it could be, and sometimes these different groups have, I come from a very institutional world, if you will, and kind of, you always have kind of an investment committee and this and that. But, sometimes you're dealing with a well-heeled family, a generational family, and you can just, some of it's functional, some of it's dysfunctional in terms of the way, and some people rely upon this, the money from this for their living, their daily lives. So I'm very, very mindful of that. We had a situation a couple of years ago. It was a Brazilian family office, had 2 brothers. One of the brothers died. The son was elevated. And what had happened there was they didn't see eye to eye on the investments, and they didn't do periodic and regular reviews. They ended up kind of on the wrong side of a bunch of stuff. They owned a bunch of office buildings, Wells Fargo office buildings, and a bunch of different secondary, tertiary markets. The market moved against them when Wells moved out. Big loss there. Then they had a bunch of other stuff that just, with a well balanced approach, because you're going to have wins and you're going to have losses. I wish I could tell you, even, I know we're talking about real estate, but also look at the stock market, right? Some days you're up, some days you're down. But I believe directionally, as long as you have, you're swimming for the buoy, you're going for that marker. And as long as you have kind of the discipline around what your risk appetite is, what your tolerances are, and understanding, when you go into and look at an investment, this is kind of it's a development deal or whatever it may be. And if I'm looking at a development deal, you got to have certain risk parameters around that. If I'm looking at a development deal in secondary tertiary market, I'm looking at least a north of a 20 IRR. If I'm looking at more of a core deal in say Boston or whatever it is, I'm probably, as an LP investor, I'm probably looking at maybe a 10 or 12. So you got to really have for me, I guess one of the things, to answer your question, I'm a little long-winded here, is to really go, when you go into a transaction, to really have a good sense of really what is the return expectation. Tell me what I believe the return expectation, and if this thing does go sideways, can I live with it, right? It may not be a 20, maybe it's just getting your principal back, right? But that's how I think about things, and I try to I have a very specific way we approach investing and thinking about things. But that's the way I sit down. We have those discussions with people, unfortunately, more frequently over the last year or so. Yeah. Where significant monies have been lost.
Yeah, and Jack, for seasoned investors, I mean, if you've been investing long enough, you're going to have some deals that don't work out, right? Mm-hmm. That's the name of the game. Like, that's every investor. You invest long enough, you're going to have some duds in that portfolio. The goal, though, is to invest for the long haul. For our newer investors, though, if that first investment or one of those early investments fails, that could really set you back. Let's talk to that person for a moment, right? Part of this is the ability to play the long game, to invest for the long haul, to recognize that you want to just have more wins than losses. And if you have more, you're gonna end up where you want to be, right? Investing almost like a game. But again, if you take a loss in that first deal, that second investment, really hard mentally to decide this investment vehicle is still a good choice. What kind of advice would you give a client who's a newer investor and that first deal doesn't go according to plan?
John, great question. A great question. I think I ask myself this every deal I look at, I ask myself the same question. Am I comfortable with this situation? First of all, why real estate? I would ask the person, first of all, if their first deal, why real estate? Number one. Is this at-risk capital, right? Two, is this capital that, a lot of these investment vehicles are illiquid, especially if you're an LP investor, meaning there's no exit. So I would say, why real estate? Understanding, that this money is illiquid. How much money can you afford to put in? And two, I think then the third thing I would say as well is, if you decide to look at real estate, what type of vehicle are you looking at, right? There's all sorts of different vehicles. There's publicly traded securities. You can buy all sorts of different things. But if it sounds like a lot of what we're talking about today, if we're looking at LP investors, why invest as an LP? I've been to a number of different road shows, if you will. A bunch of people that I get approached all the time to invest $100,000, $200,000 into different projects. And generally the answer I say is no, right? And really fundamentally what it comes down to, I don't believe in the project. I don't believe what that generally means is I'm not necessarily 100% comfortable with the sponsor in terms of their area expertise and how long have they been doing this stuff. How long have they, returned capital to players? Tell me about their investment approach. Tell me how they find these opportunities. How do they manage the project? Tell me how many round trips they've had. I want to see somebody's book of investments. I want to see, and I know, John, one thing I looked at your company, I see you guys have, you've done a bunch of multifamily. You've done almost $150 million, 1,500 units. Your target IRR has been a 19 or so. And by the way, I don't get paid. I didn't like to say that, any of these things. I always like to say this. But I'm not. But my point is that's a decent track record. Yeah. But my point is I've always come in whenever I look at real estate investing with skepticism. I'd say, why real estate? How much can I afford to invest? Why am I picking that sponsor? How long can I not see that money? And is the targeted return I'm looking at adequate? Because the reality is right now, especially over the last few years, I basically do nothing and get 5%. Sitting at the bank, right? So if I get 5% at the bank, what's the risk premium that I'm going to accept, for basically a liquid investment, something I can't touch for potentially, if we're looking at LPs, say it's a 3-year exit, 3 years, right? Am I being adequately compensated for that risk?
Yeah, 3, 5, 7 years. I mean, that's a chance you're taking there, right? And I think it's really important too, because we always talk about this investing, especially when you're looking at LP, is you're first and foremost looking at the who's the team, who's the sponsor, who's the operator, 100%. Who's the one making the day-to-day decisions, because they're going to be the ones largely in charge of the returns. I mean, that is why it's a passive investment. You are putting your hope and your trust into the person making those decisions. So you do want to know their track record. You want to know their history. You want to know their investing thesis, because that's what's going to help you understand what you can expect. And you mentioned that you get approached all the time, but most of the time, almost all the time, you're saying no because you're not comfortable with the sponsor. And it's important for people to hear that and understand that, because I always like to say two things. It's like when you're an investor, an operator, a sponsor, your job is to find the people who are looking for your deals, but you also have to do everything you can to educate yourself, to surround yourself with the right people, to build the right team, to go and execute the deals. And when you're saying no, part of that, or a lot of that, is because you recognize they have not done that. They have not built the team to take down these deals. Like, you don't have the trust that they have the team to take down those deals. For that person who is looking to scale as an operator, as a sponsor, to do more deals and to raise capital, what kind of things do they need to do today to position themselves to raise more capital?
It's a great thing. It's great because I talk to a lot of folks, a lot of friends and the like that, they initially raise some capital. They do a couple transactions, but then they do a lot of friends and family. They'll do that type of thing, friends and family, RIAs and things like that. But then they want to go to the second level. And we work with a lot of those groups that go to the second level, want to make institutional commitments, $100 million, $200 million for a programmatic approach. I think when you look at it, I almost look at it looking at an org chart, right? I look at, okay, tell me about the team. Generally, a lot of the initial group is you probably have a sales guy, maybe a capital market work. Some guy worked at Cushman. He's a sourcing guy, finds opportunities. Good sales guy. That's one. Two, you may have someone on the risk side. You got Mr. Inside, Mr. Outside, if you will, he or she. you got the inside person that kind of evaluates the deal. So you got two people, right? Great. But then in terms of when it comes to the institutional reporting, right? In terms of, if I've made a given, someone giving them, $500,000 and we have say 20 LPs and got $5 million and we got to do certain reporting to keep people comfortable. To go from that level of, I don't know, 2 or 3 properties, say it's, 2,000 units to the next level, because the problem is, life happens and things happen, and I think either, particular markets, things can happen to people, things can happen to the capital markets, like what happened with treasuries blowing out and company, debt become more expensive. So my point is, I look at where we are today, and then I look at potentially where we're going, and from an organizational standpoint, to make myself more attractive. And I'm just looking at this from a shop looking to raise capital, because we do a bunch of that, right, for others, right? So if I look at a shop looking to raise capital, I am here today, and this is where I'm looking to become. And maybe you need someone in investor relations, you need to have tight reporting around, SOC and all this type of stuff. And how am I reporting out to investors? Tell me about the deal pipeline. How am I finding these opportunities? Tell me about when you go on your road shows and you meet with people, tell me what tell me John's target. I want to hear about John's specific target. What is he looking to target in terms of looking at multifamily, up to 200 units, 70s, 80s vintage, Midwest, and that type of thing. So that's how I look at things. I want to be, when I look at investing, I look at people's ability to kind of run a process. You kind of do it onesie twosie, and then you kind of move to a more institutional framework. And then they also, on an asset management basis, how are you going to manage the properties day to day? Are you doing it? Because again, a bunch of guys sitting up here in Wall Street or sitting up here in Connecticut, and you're owning a bunch of stuff down in Charlotte or in Cincinnati, and you're third party in it. It's, you get hometown. A lot of times you get hometown, and people like, hey, what's going on at the property? And because the guy locally is incentivized probably to drive occupancy. He's letting anybody in the front door. You're not doing credit checks. You're not checking people. You know the drill. So we're very much look at organizationally how you set up. What are you doing? 1, then specifically tell me how you're deploying the capital. 2, then 3, how you asset managing day to day. In terms of achieving the plan. I remember one company we were working with, a company called Cadre. It was an institutionally backed company. You probably know of them. We were doing a bunch of work for them. They backed a bunch of LPs. They were the capital provider. And what we would do on a monthly basis, we would evaluate how is the operating partner doing. And, and we were kind of as how the rent's going, how the reno going. In a lot of cases, when you're doing that type of thing, in a number of cases, they're spending the money and they're not getting the lift that they anticipated. So you got to have the institutional. You got to be. I'm very institutional, but you got to be able to you're an LP investor. When you're working with the people that you gave them money, you got to be able to kind of go to them. Tell me how we're doing on that property, that 200 unit property in Cincinnati. I know how are we going with the with the reno. Are we seeing acceptance of we spending the 10 grand, we're getting the $150, $200 rent pops or not, right? It's tell me about supply cost. Are things coming in line with my point is I'm very, very, I can go from 30,000 feet to 10 feet off the ground. And I think as an LP investor, how are we doing against our budget? We're budgeting for HVAC, right? We're budgeting for tile. How are we doing against those numbers? Those are all numbers on a spreadsheet. But when the numbers on a spreadsheet and a budget, how are we actually doing against plan? And that's on the cost side. And then how are we doing on the other side, on the revenue side, on the income? Are we getting the rents we anticipated? The other income? We talked about RUBS. Everyone loves Institute RUBS programs. Sometimes they work. A lot of times they don't. Which RUBS is, you basically charge for utilities, that whole thing. So, but again, John, I'm very tactical. I like big themes, but then I want to verify, so that's I keep talking about that.
Yeah,
for sure.
Jack, I love the way you frame that up, right? Because it's important to understand just how the deals work. And you started talking about that newer investor and just why real estate. So if you're getting into this space, you have a deal that's not working. One of the first things you got to look at is, well, why real estate for you? And has that changed? Because sometimes why real estate was just because you thought you could make a lot of money and it was easy, and find out it's not. So maybe you're not as passionate about it. It's amazing how many people lose an interest in something when they find out it's harder than they initially thought. So if real estate is no longer the vehicle, that's fine. But if it is the vehicle and it still just happens to not be working out, you can reevaluate what happened to that deal and then reconstruct your investing thesis and your deal criteria moving forward. You talked about a couple things though. One, you're looking at operators and you're talking to folks who are looking to raise capital. You really want to know, who the sponsor is, what's their targets, what's their buy box, what is their pipeline, like who they have, who is actually analyzing these deals, right? Do they have someone in-house? Do they have somebody outside of the house? How are they managing the asset management component of it? Because you want someone who has boots on the ground, who understands that market, and they can really execute the plan. And really, if I could summarize it, it's about the professionalism of the operation. You don't want a one-man shop you don't want a one-man shop who maybe is really good by themselves, but you need reporting. I took a note and I didn't know what it said. It said reporting. Sometimes I write my notes so quick. Sometimes I'm
same thing.
I have no idea what that word's repeating. What is reporting? That's what it was. But you talked about the reporting, which a lot of folks don't understand. But when you work with institutional capital, you really have to start reporting at a much higher quality level because they have their own standards and you have to adhere to those standards. And if you're new and this is your first time working with those guys, you may bite off more than you can chew if your reporting docs aren't up to their code, and maybe you don't have that background. So it's just something to be mindful of. But going back to it, it's about professionalism, because no one wants to see something that only works with you. They want to see a company. They want to see a business. They want to see an institution, an infrastructure that can execute the deals, not necessarily to kick you out, but something that's bigger than you. If you are everything, you're the sauce, you're the glue. No one wants to invest all their money in that, as much as they like and love you, because the truth is something could happen to you. Not catastrophic. I know people always want to get hit by a bus, but something could happen. Life can happen, right? You might be going through something else or whatever, and they want to make sure that there's at least the infrastructure to repeat the systems and processes to find success. So if you really want to scale, professionalize your operations, and that's going to set you up.
And I would say, the guardrails. And I think I was thinking about it as a first-time person getting in, you're going to learn. I think anybody that does anything for the first time, you and I, we go out for a sports team, and guess what? Everyone's always like, and I'm, you get on there and you're making the big play, and guess what? You drop the ball. Right? You're like, we've all done it. But I think the same thing with when you get into in real estate investing. Why? Well, you think there's whatever, who knows? Someone said to you, hey, real estate's the place to go or whatever. So you maybe make a modest investment. There's a lot of different ways to do that, but you go through that process, you study up, you book up a little bit. But I think you find somebody, a mentor, somebody you trust. It takes sometimes time to do that. Who knows? It may take maybe it takes a year, maybe you never do it, but you do that and you get somebody you trust and you're comfortable with. You make a modest investment, ask a lot of questions, and see how it goes. I'm a big believer with anybody, even some of our clients. I'm like, I sound good. All these different things we do, and I've been around the block a bit, right? But I'm also, not I look at almost, I'm on probation. It's almost like you go on probation. It's a trial. You go into something with a modest investment. Hey, we're going to buy this multifamily property. We think we're buying it right. And you can, again, if you're an LP, they should feel very comfortable that the institutional group should say, hey, John, I'm going to show you all my analysis. This is what we're doing. We're buying this thing at, we believe at a good number. We believe that doing these things we're talking about, we're going to do okay. I've also seen someone down the street's done the same thing for a similar property. So there's market acceptance. You spend 10, 20 grand a unit. We got a similar project. It's almost like a mirror building of the one a mile away. That we could potentially do the same thing. So you got market acceptance. Okay. Then I would say, okay, John, who's doing the work? Right? You got someone who's doing the work, and how long have they been with you? And I'll tell you the one thing I'll tell you, John. The other thing I would tell you as well, and this is a life lesson. Choose your partners carefully. Right? I've seen this on the ownership side relative to real estate. I've seen this for bank groups. I've seen a bunch of the bank groups we're working with now that they're not all aligned. They have different ownership groups. They have different potential regulators. And guess what? They don't all see eye to eye. So my point is, you're an LP, you're a partner with the GPs. Pick your partners carefully, and vet them. And anyone that's raising money and you're giving money to, you should not be afraid to ask them, hey, John, what's your worst case scenario here? And you may, I'll be curious to see it because again, John, I don't know about you. Not everything, as we talked about ad nauseum here, not everything goes as planned. But John, you should be able to kind of go back to the LP investor and say, Mr. LP, the reality is I believe that we're targeting this, but I believe it might take a little longer. But my basic principle that I have to every investor, and this is what I've done through a bunch of times, is not to lose principal. You may not get the 20 or the number we're promising you, but we're not losing principal. And that's kind of what I'm working for, even if I don't have to work with my promote or whatever it may be, or what I got in this thing. That's my promise to you as an investor. That's kind of a lot of the way I think about things with working with different groups.
And Jack, I think that point there is so critical because investors are optimistic, right? Well, you should be, right? When you're looking to write a $50,000, $100,000, $1 million, whatever check, you should be optimistic about the investment, right? And real estate investors are innately optimistic. They're going to tell you all the great stuff that could happen. And this is why this is going to work. And this is going to be awesome, right? And what ends up happening is for a long time, that optimism was paid back, twofold, right? I mean, just crushed it. We thought it was going to be a 5-year hold. It was a 2-year hold. And
that's right.
We made three times as much money as we thought we were going to make, right? It's great. But we're at a point now where that has shifted. And now folks realize, hey, it's not always going to work out exactly as you thought. And it's not to say we want to, squash the optimism, but we also have to add in the realism and also just regular business planning and sitting and doing that SWOT analysis and understanding what are the threats to this? Where are the opportunities? Where are we weak? Where do we have exposure? And if you can do that, then you can put together a sound business plan where it's not just based on the upside. And to your point, if you can take a look at whether it be a sensitivity analysis or at least looking at, hey, here's a worst case scenario. Here are the things that could impact our investment. And if this happens, here's how we're going to react. I think it's really important to have people who can recognize that, have the humility to recognize that there's no guarantees. And there are absolutely things that can derail your business plan or your property that some you can control and some you can't. And to understand and recognize, okay, if this were to happen, here's how we adjust. Here's what we're going to do. And to your point, it comes to downside protection. And every investor is in a different phase of their life. Some folks are maybe early in their investing journey and they've got a 50-year runway. So they want to swing for the moon, right? They just want to do stuff that's going to triple their money. And if it's a little, you mentioned like a little 8-10% IRR, they got no interest in that, right? But they just want to go for the home runs. And that's great. There are people on the other side of that, though, who are looking to live off of this, maybe from almost a stipend, who are looking for maybe the monthly or the quarterly distributions. And they probably want a more conservative investment. So it also is important for both parties to understand what kind of deal do you have? What is the true risk profile? And who is right for that kind of investment? And I think for operators and sponsors to understand your LPs or your investing partners so that you can make sure that they're investing in the right deal, because many of them may not fully understand where the level of risk or exposure lies in a deal. They're only going to go off of what you tell them or lay out in your operating documents and your PPM. And the truth is every deal has some level of risk, but you have to make sure those people understand and are ready to take those risks. And again, all those documents legally, take care of you. But on the same note, we want to make sure that people understand the investments that they're making and that they can make better, wiser, more intelligent investments as they progress on their own journey.
John, well said. Very well said.
Yeah, Jack, let's talk a little bit more about kind of what you're working on in the business now. So we talked a lot about the state of the economy and the economics as far as what people are looking for in advisory services. Where are you kind of focusing your energy and effort today and moving forward?
I think it's great, John. It's a great question. And like I said, I started during the great financial crisis. When we first started there, like I said, one of our first large engagements was Lone Star, big institutional investor, buying a $3.5 billion bank. down in out in Chicago, actually not out there, and had a big team and evaluating that. Got a fair amount of that type of stuff. Most recently, we've been focused. The market has been it's been a difficult, I would say, debt market, and it's been an even more difficult market to raise equity. A lot of groups are underwater with a lot of their investments. Everyone knows about what's going on in office. The reality is, I think, everybody kind of knows, what's happened there. But not all office is created equal. I would say, I was just talking to one of my buddies who was over at JPM. He's one of the head appraisers. They're making new office loans in New York City over on 1251 over on 6th Avenue. So these are well leased, well occupied buildings. They believe that they can get these deals. So not all office created equal, but a lot of the office is out of favor. We're doing a fair amount of some new deals on the multi side. I would say our business right now is probably 60-40 between restructuring, if you will, 40% new business. Specifically the restructuring, we've recently completed 2 CRE CLO collapses. We're working on another one right now. What essentially that means is a lot of these multifamily loans that were made over the last couple of years were put into these vehicles and then sold to investors. And a lot of them have gone sideways because some of the things we talked about, really the 3 areas, one being the operational issue. They didn't execute the operation, right? They didn't get that done. Then on the capitalization, the value is down and the debt is matured. So they're hung. So what they've done in a lot of those cases is they've collapsed those structures, put it back on a warehouse line, get out the servicer, so it allows them to restructure the deal, sell it, bring in again, what they typically will do is they'll sell the note 1, 2, they'll potentially they'll take it back as an REO asset, they'll bring additional capital in for their own account, or they'll do an AB structure, meaning they'll bring in another investor to kind of manage it. Right, so that's kind of what's happening in that world. Then we're doing a fair amount of
Jack, I want to jump into that. So,
sure.
What you're talking about, you said CRE CLO collapse, and what you're getting at is when the lender is essentially foreclosing on the operator, taking that property back, and then they may have to inject more capital into that project and or bring on another operator to take over the day-to-day execution and management, so they can ultimately get to a point where they can sell the property.
That's
correct?
That's correct.
Yeah.
Essentially, what the securitization vehicle is, a vehicle that has 30 to 50 loans is part of it, and what they're doing is collapsing that structure. Then what they can do is the individual loans that are there, it's easier for them to restructure. So again, in certain cases, they'll take that, like we just said, they'll foreclose out the owners, they'll own it. Then they look at their remedies, one of which we talked about is they potentially bring in additional investors. They can use their own, manage it themselves and deploy their own capital. Or thirdly, they can sell the property. So, but that's something that we've been doing a fair amount of that. Then we're doing, like I said, a fair amount of restructuring work as well. Acting as operator, if you will, we've got a number of projects, multifamily projects that, got fire burned out units and water damage. There's been a destruction of value, and I have people that work for me that we're pulling that capital to bring these things back online. Where, for instance, the property was worth $30 million, now it's worth 10. We believe that through fixing up the units and reperforming, building a website, doing a bunch of these things, we'll get it back up to 30 and recreate value.
As investors, most of our listeners are, either active or passive investors. I imagine mostly active. We all know there's opportunity in the marketplace now for the reasons you just laid out. What advice would you give to an operator to position themselves for some of the deals that you just kind of talked about, right? Where, we know that the lender is taking it back. They're looking to get it off their books. Maybe they got to drive some value first. Like, what tips or advice would you give those operators to position themselves to get those kind of properties into their portfolio?
It's a great question. I think everybody, everyone always generally everyone always talks about this deal wasn't marketed, right? And the reality is, it's the bank or this or that hasn't really marketed the property. And the most part, that doesn't happens occasionally. We have a bunch of banks we work with that we're brought in to help or things like that. Sometimes they're done with other related customers or things like that. But generally, most of the stuff is widely marketed through, a bunch of, the auction platforms. You might bring in a CBRE, you bring in a JLL, whoever it may be. So, you can talk to your local banker, I think, and things like that, whoever you may be, talk to the local banker. What do you have? Do you have anything that you may need a partner? The other thing I would say specifically looking at, looking at what's out there. I get, like I said, I'm John, unlike you, I'm sure you get inundated with offerings. Something's being sold in Jacksonville, someone's being sold here or there or wherever. I get a lot of that, but again, I have to make sure that, if I'm looking at that, that it meets, like we talked about, I have my investment approach, my thought process around that. How can I add value? Right. And that's ultimately how I can optimize my value is how I would, and I have a very rigorous pricing mechanism around how we target returns and to buy it right. How much value can I create for myself and my investors? Right. So that's how I think about it. Really, the three buckets there.
No, I love that, Jack. For our listeners who are intrigued with our conversation and want to know how they can work with you and your firm or firms like yours, what's the next step and what would they do?
Yeah, no, hey, John, thank you. You can reach out. We have a website, www.summerstreetre.com, or my phone number is 203-257-2492. And that was my cell phone. I gave you my cell phone number. Call me, and we really enjoy helping people figure out their real estate journey, so to speak.
And Jack, I know you mentioned you work with LP investors, institutional investors, but who is like an ideal client to work with? Like, is it a dollar amount, or how do you frame that up?
It depends. It really runs all food groups. I mean, it runs across the spectrum. I think sometimes I have a friend of mine who was a money management person. He had like a doctor type person, and he had a bunch of holdings in this whole LP thing. He said, Jack, meet with my friend, and I just got on the phone, we kind of talked, and had my team do a little analysis a day or two, and we kind of we did it as just a consultative thing. So we work with that. Then we have very, very large institutional family office clients with, multi-billions of dollars that we work with. So it really, John, it really runs the spectrum. We're a boutique, high-touch advisory firm. We're really and also investment. We like to really focus on the real estate journey and really helping people solve their problems and kind of and sort things out. So that's a lot of what we do, John. That's our focus.
Love it. Well, Jack, great stuff, man. I appreciate you just sharing more about kind of what you're seeing. Obviously, there are a lot of deals that are challenged right now, doing capital calls and trying to just kind of hold on and navigate, until the next opportunity. And you gave some great advice on how to look at these deals, almost treat them like new deals, and really understanding both the operational side of it as well as the financing side of it, and really making a sound decision and investment from there. So lots of great tips throughout this conversation. Again, if you want to find out more, we'll put a link to Jackson and his team's website in the show notes. Jack, thanks again for being a great guest and coming on Multifamily Mastery. We look forward to staying in touch with you, and we will talk soon. Take care.
Thanks a lot, John. Take care.